Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today is April 3rd, 2025, and today on our call, we have the CEO, Joe Walewicz from Neupath Holdings. Neupath trades on the TSX Venture Exchange under the symbol NPTH. The company is currently trading at 18.5 cents with about 56 million shares outstanding, or about a $10.5 million market cap. I'd now like to hand it over to Paul Andriola.
Thanks a lot, Trev. Joe, great to have you back. We last spoke, I think, in December, and you've had a couple nice events since then, including your Q4 numbers. So happy to have you here to talk about that. So let's get into the update. But before we do that, let's remind everybody what Neupath's all about.
Sure. Well, I'll just give a quick update on where we were since we last spoke, and then go into the company a little bit for people who may not have been there. So yeah, I mean, first and foremost, you can see on the first slide we are Canada. Well, first, I'm Joe Walewicz. I'm the CEO. I've been running this for about 2.5 years now, and joined the board actually pre-RTO back in 2020. So I've been on the board for about 5 years now, or at least involved with the company for 5 years, but actually running it for about 2.5. Stepped in 2022 to kind of clean up a difficult situation, and I think we're in a good place right now. So what is Neupath? We're Canada's largest network of chronic pain treatment facilities. I'll describe that in a little bit for you. Obviously we're public, so we'll make forward-looking statements. We do use non-IFRS measures as other alternative measures for looking at some of the ways that we look at our business. So let's, I just want to start quickly with since we last spoke, because some of you may have been on it when I spoke in December. Fourth quarter was our best quarter ever. We're up 12% year over year. A reminder, no acquisitions there. This is all organic growth. So the business, underlying business is doing pretty well. I think more importantly is EBITDA was up 18% year over year, and I'm always happier when my EBITDA is growing faster than my revenue. So also seeing high double-digit growth there. Full year adjusted EBITDA up 19%, but more importantly, an adjusted EBITDA positive cash flows. And we made use some of those cash flows to make significant investments in our facilities to support future growth. So we built 3 new fluoroscopy suites. These are specialized treatment rooms. We put 1 more in Edmonton, 2 more in Ontario, that allow us to do certain specialized procedures. In Q1, we were the first ever in North America to provide injection of arthrosamid. We've since treated a number of patients with this. We're super excited about this. This is a new cash pay procedure that's attracting new patients. In fact, because we're the first in North America, this is a European company that launched it a few years ago. 7,000 people have been treated. It's a new product for arthritis in the knee, and we're getting a fair number of people south of the border looking at this because it's still not approved yet by the FDA. We hope, we expect it will be at some point in the future, but in the interim, we're going to take advantage of that and treat patients who are looking for this really innovative new procedure. Finally, I'd say the kind of, I won't call it the icing on the cake, but maybe the cherry on top, and sort of, the last 2.5 years of trying to fix this business, getting that new credit facility with National Bank. 2.5 years ago, we had or 2 years ago, sorry, we were in the midst of a terrible market trying to finance. No one wanted to put money in. Myself and my chairman, were able to kind of backstop some of this deal along with our existing shareholders to get a tiny little debenture deal done. Very painful to do that. Nice to grow up and be a big boy now and have a proper bank facility. What we really like here is it gave everything we wanted. We told investors in the past, an ideal situation would be a credit line, term debt, and an acquisition line, and that's exactly what we got. And on attractive terms, prime plus, I guess is the best way to describe it. Under 6% would be the cost of capital there. So very excited to put that there. And then, we're really pleased that, more importantly, I couldn't have done this 2 years ago because banks didn't even want to talk to me. So I think all the hard work we've been doing behind the scenes in fixing the business and making it better has allowed us to do this, which is going to allow us to do all the other things that we want to do. So For those of you who don't know, Neupath, I mentioned we are a provider of chronic pain treatment. We're Canada's leading provider. We're currently in Alberta and in Ontario. I don't need to tell anybody this is a large growing market. This is a huge market. 20% of Canadians suffering with chronic pain. We have large wait lists in our clinic. Just to be clear, I'm not looking for customers. This is actually not my challenge as I grow this business. So I'm not worried. We have lots of opportunities to grow, both serving our existing in Edmonton 18-month wait list, in Ontario 2-week to 3-month wait lists. I have lots of opportunities for growth, just serving those people that are not yet being served, but also looking at new procedures, like I mentioned in the past. What we run, and sometimes we talk about as a clinics business, and I use that word clinics and facilities interchangeably sometimes, but we really are a facilities operator. And what I mean by that is that where I'm sitting right now is a doctor's office. If I was a doctor, I could not do interventional pain medicine in this room where I'm sitting. And that's because the air quality isn't right. I don't have a nurse on staff. I don't have crash carts sitting outside of my facility. There's a whole bunch of little things that go into these regulated facilities. And so, for example, in Ontario, our what I call clinics, sometimes our facilities are regulated by the College of Physician Surgeons of Ontario. And, we put in about 1,000 pages of regulatory documentation to get a facility approved. We takes, anywhere up to 3 to 6 months to get that approved. And they come and inspect us on a regular basis. And we have additional regulatory pieces that fall in there. So, air quality, infection control, nurse staff ratios, crash carts, sizes of the doors even are part of that regulation. So these are regulated facilities. And we have specialized equipment that go in there. Well, I would say kind of what people sometimes ask me, I say, there's a hospital and there's a doctor's office, and we're kind of in the middle there, in that regulation piece. And I say that to lead into the next one, where we're well positioned for health policy. I mean, what we do in interventional pain medicine is what used to be done in the hospitals. And if you think about that, there are a lot of things that used to be done in the hospitals. There's the Shoulder's clinic in Toronto that does hernia repair, and that's in a private facility. There's no need for a hospital to do that. You can do, cataract surgeries outside of hospital. It doesn't need to be done in a hospital. Canada, we traditionally have done it. If you go to the US, you're never getting cataract surgery in a hospital. You're going to go to a specialized treatment center. And I think the whole idea is that what people are learning in the medical system worldwide, and Canada's probably a little bit further behind, is that complicated procedures, overnight stays are good for a hospital. In and out procedures, hospital's a terrible environment. And so I think what you look at when we look at what we're doing is same as private surgery, same as some of these other procedures, whether it's lab testing, used to be done in hospitals. Now it's done, no one goes to a hospital to get lab tests. You go to the clinic around the corner, get your blood work done, right? So there's a lot of this that's been changing in Canada, and we're just in that universe. It is I would say, successful turnaround from going from distressed debt offerings to tier 1 banks providing us capital at 5.9%. This is a big turnaround for the business, and I think we're hopeful that the street will recognize that as well. We are actually a rather large operation, 200,000 patient visits last year. 165 healthcare professionals. We have 100 physicians on our roster. This is a big operation. Lots of different specialties here: physiatry and anesthesiology, orthopedic surgeons, GPs with specialized training, sports medicine, and we work with physios and other allied health professionals. And I think for all of you who've seen this, I'll go through it in relatively quick order, so you can see that on our website as well. Just updated with our Q4 numbers. What I'm happy about, as I said, is when my EBITDA is growing faster than my revenue, when I got a high single-digit revenue growth, essentially all organic, but with the bank financing in place, I think we'll be able to execute on additional growth opportunities. In terms of the EBITDA, we've really spent a lot of time trying to tinkering under the hood to fix this business. You can see it, whether in the previous slide you saw it in terms of capacity utilization, whether it's in purchasing and how we buy some of our medical supplies. All these things we're doing to be able to serve patients better. Whether it's IT, we're using we're testing out some AI scribe technology for some of our docs. I'm not going to talk about AI as anything other than a tool that we use to better manage their time, because that's ultimately what I need, is more doctor time. So then, continuing on, I mentioned the operational turnaround, but the balance sheet turnaround has been phenomenal. When I took over, when the board stepped in to run this business, we were cash flow negative, and we had $1.5 million of cash, and $7 million in net debt. It was a terrible place to be. I don't wish that on any of you. Taking that from, decreasing our net debt by half, and increasing our total cash on the balance sheet, turning to cash positive from cash negative. That's been what we've done. But just to be clear, while investing in our facilities, we built 3 new fluoroscopy suites last year. These are very expensive, let's say about average $250,000 each. So we put that capital, that cash flow into our business. We're not just, frittering that away, so to speak. Just a note on the net debt. When we talk about net debt, I talk about interest-bearing debt and, bank debt, like kind of traditional loans. I know under IFRS, we do put all that debt related to our leases on our balance sheet. I won't get into the philosophy of leases versus bank debt, but we and our bank treat those differently. And more than happy to have that long conversation with you over a coffee or a glass of wine. On the next slide here, let's talk about our cap structure, because it's really, really tight. We have here 44% insiders. We have Claret Investment Management in Montreal. They're a $2.7 billion fund management company. They own 12% of the business. They've owned 12% for a long time. They bought 12% of that last debenture deal. Bloom Burton, where I'm sitting right now, is 32%. And as well, myself, non-founder CEO, I've acquired 600,000 shares in the market. Surprisingly difficult to do, given all the blackouts and our liquidity. And our CFO also bought on Monday as well. The buyback we launched in Q4 in November, for the simple reason that I can tell you flat out, whatever you think my valuation is, however you want to calculate it, I know when I walk into a doctor's office, if I offered them for their business what we trade at, they will say no, and they will kick me out of their office. So, in that case, in that scenario, we of course have 2 avenues. One is to buy back our stock, and 2, to see if we can get bank financing, which is lower cost capital. So that's what we've done. And so hopefully now, with the one part of my cost capital solved, I can start hitting some singles and doubles, and with the with the momentum, hopefully over time, in the shares, we'll be able to use all parts of my cost capital. We are trading at highly discounted multiple versus our peers. Certainly you want to look at business that looks a lot like us, go look at Well Health. Obviously different scale, but still, running a lot of medical clinics, and certainly different numbers that you'll see on their valuation side. So as Trevor mentioned in the beginning, 56 million shares outstanding. We have market cap of 11, maybe a little bit less today, but fortunately a little bit less than everybody else. We have the warrants outstanding. Those expire next year. I shouldn't say that. There's 4.5 million warrants that expire next year at 25 cents, so above where we are today. And that's those are held by an insider. That's Bloom Burton's from pre-RTO. And then there's the balance of that is our broker warrants from that distressed debt financing we did 2 years ago. And of course, those expire in the next few weeks. So we're doing a lot of work on getting those into friendly hands. The options pool, less than 10%. There's a good chunk of those that are well out of the money, and then some that are less so. But that gives you a sense of the share capital. So very tightly held. I think that if you look at, I mentioned that insiders, so Bloom Burton and Claret, as well as other insiders, plus I make about 5 phone calls. I think some of you may even be on this call. I get to about 80% of my shares pretty quickly. So tightly held, which sort of limits our liquidity piece, which the good news is I have great shareholders that are tightly held. The bad news is there's not enough shares out there for new people. So working on that. We'll see how we can help over time. I did mention earlier that, really the growth, I want to talk a little bit about our growth and how we get there. These, attracting and retaining physicians is the biggest part of what we do. Our health system, the U.S. health system, every health system in the world is supply constrained, not patient constrained, generally speaking. People can never be too healthy and never get as much healthcare as they want. So we definitely try to work very hard to retain them. How do we do that? Well, these are regulated facilities. It's pretty complicated. It's not a doctor's office where they just walk in and start, seeing patients. The purchase of new technologies, you're looking in that picture right there is our Health Point facility in Edmonton. It's 25,000 square feet. I got 3 fluoroscopy suites there. That's a lot of capital that's been put into that business. It's hard to recreate that. It's a lot of work to do that. We have a built-in referral network. So I mentioned to you, Health Point has an 18-month wait list. We had one of the 2 grads at U of A joined us last July. It's a great thing for a student coming out with, tens of thousands of student debt coming into a facility where we have 18-month wait lists and they're immediately full. They don't have to build a practice. So for a new doc or someone moving to town, we have a doctor from New Brunswick we're evaluating for Edmonton right now. It's amazing for them to come in and see, wow, this is just like working in a hospital. I don't have to build up my practice. It's already there. And then, we, of course, do all the other stuff that I view as lower value, but still important. We do all the HR, IT, admin, pay the rent, et cetera. So it really makes it easy for them to just walk in and do their job and go home at the end of the day. So we've been pretty good, pretty low turnover in our business, and we're pretty happy with that. Still always recruiting and looking to add to our roster. Beyond that, of course, bringing on new doctors, right sizing our clinics. That's how we've got our, you saw our on a previous slide, our capacity utilization 74% last year. There's going to be a peak at that. I think as we get, higher and higher, I never want to be at 100%, although financially, the finance guy wants to be at 100%. But the reality is that if I'm trying to recruit a new doctor and I say, well, I can give you Sunday nights, it's not really a good recruiting tool. So, I have to kind of always have a little bit of slack in the system so that we can recruit new physicians. Also adding new services. I told you about this new procedure, arthrosamid, that we launched in our clinics. That's a private pay procedure. We also do PRP procedures. That's a plasma-rich protein. You may have heard about that. You probably see an athlete, hockey player go down, a baseball player go down, and they'll say, oh, so, Aaron Judge went for PRP injections. It's really a good sports medicine product. It's great to help with the healing post injury. And that's a private pay procedure as well. And maybe I'll just take a quick segue. Private versus public. If the government pays for it, I'm not allowed to sell it to you privately. And that's our model. And so we are a private provider of public health by and large. However, if the government doesn't want to pay for it, doesn't like to pay for it, like arthrosamid, like PRP, then we can provide it to you cash pay. So if the government starts reimbursing it, then I won't be able to charge you anymore. So that's kind of how we look at it. If the government doesn't want to do it and people want it, then we're more than happy to make it available. And I have the nurses, the technicians, the doctors who can do that for you. So expanding our network, we were in Ontario only until 2021. We bought in Edmonton that year. In 2022, we expanded to Red Deer. We're still looking at new sites, looking at partnership opportunities like we did in Red Deer. And then finally, expanding in adjacent markets. I talk a lot about orthopedics because if you're a candidate for surgery, you may have been being treated for pain. You may be a candidate for surgery. Conversely, you may be referred for surgery. You may not be a candidate for surgery, but you're still in pain. You can come over to our side. There's a natural fit there. So if I ever saturated the pain market, if I ever saturated all the provinces with the pain business, I certainly see orthopedics and specialties with high overlapping cohorts as kind of a great fit for what we do. So definitely, radiology and imaging also great fits adjacent to us. If you're coming into one of my clinics, you probably had a scan of some sort. So, why refer them out? We can refer them in, so to speak. So those are kind of natural if I was to go outside of my core pain business, things that we can do. And there are great models for that in all the provinces. So in summary, I think the same slide I probably talked to you before, so apologize for recycling for those of you who have seen this before. We, really, I'd say successful turnaround. I don't want to say, the George Bush mission accomplished, banner behind me, but, certainly we have turned this around. And so But the difference between surviving and thriving, we've now successfully turned this around. It's a great business. To make this truly successful is going to be next level, and that's where we're focused now. Is how do we invest in the people, in the new technology, in the businesses that will make this will accelerate our growth going forward. Lots of opportunities for growth. I really, really don't worry about that per se. We haven't saturated the market in Ontario. Even I'm not in every market I want to be in Ontario. I'm not in every market in Alberta, and then I'm not in every province in Canada outside of those two. So we fit with this sort of broader government policy of kind of moving things out of hospitals, whether it's surgery, whether it's pain injections, whether it's other types of procedures that just don't require that infrastructure. The demand is rising. We have great market share in our key market regions, and I think the team. We've been not only have skin in the game, we're adding to that. Both the board and the CFO and I are continue to add, and we're at a low market valuation. So I mean, this is a difficult market. I will add that I said to Paul before the call started, I just said, am I worried? Well, we worry about the world in general, but I supply Canadian doctors to Canadian patients paid for by the Canadian government, paying rent in Canadian dollars. We're not, no one is ever 100% insulated, but we feel pretty good about, whatever rants and ravings happen south of the border. Our business is not really directly affected by any of that. So we're pretty good. We can continue to just run our business and focus on that. I mentioned myself, almost 30 years now in healthcare, 16 years as an equity analyst covering Canadian healthcare at the big banks. Brendan Wood's a ranked analyst, moved back into industry, worked at a number of successful public companies, about two of which have exited for multi-billion-dollar. Paladin was, I was working at Paladin, worked at Clementia. Both of those were taken out for over $1 billion. My CFO, started out as a controller here, was doing such a good job. We elevated him to CFO, doing a great job running our operation. We have 4 people now in the operations, on our IT and regional VPs running the business, and have been doing it for most of them for a very, very long time. So very, very good organization here. So, and that's kind of the end of the deck. I'll stop there and maybe leave it to Paul if you have some additional questions.
Well, thank you. Thank you so much, Joe. Reminder, everybody's listening, if you've got a question you'd like me to ask Joe, please use the chat function and I'll read out the question. Maybe let's just dive back to Q4. Company's got nice growth in Q4. You mentioned sort of some of the reasons behind that. Have you kind of exhausted what you can do for growth? Is it now more dependent on M&A or launching new services? How can we look sort of on a go-forward basis in terms of growth?
Yeah, it's a complicated one because all three contribute to growth, and I think that, in 2025, we're going to start, see some of that more like our PRP and our arthrosamid program will give a little bit more on the private pay side. But at the end of the day, it's physician hours and it's not just number of docs. So I can, like I said, earlier I mentioned I had 100 physicians on our roster. There are 1, 2, 3, 4, and 5 day a week doctors. So, how do you take that 1 or 2 day a week guy and get him to add a day or add the docs, just, convince them to add extra time with us. Some of them, make the day more efficient, with their technology. If I can take a half hour out of their paperwork at the end of the day, through new technology, that they'll give some of that back to me, and that'll be more patients we see every day. So working on that, and then so the M&A side. So how do I think about the growth? Well, 1, recruiting new doctors to my facilities. That's a great way to do it. That's 2, adding a new facility in a new location. I'd say that adding new locations in our existing markets is less interesting because then you're looking at a rationalization piece. I'd rather recruit those doctors and convince them that, it's better to work for me than the other place they're at. But like I'm not in Calgary, for example, that's a buy versus build decision. We have both, we've evaluated both, and, we'll make a decision on that we'll make decisions on that over time. Entering a new province, like, going to BC, for example, we're looking at buy versus build scenarios there as well. It's all about, the physicians, right? Like, so if I can
Mhm.
find a group, if I get a site in a new location, I know I can fill it with new doctors, and that's kind of where we look at that. So it's been but sorry, I see all the questions popping up in the phone there. Well, distracting
Yeah.
ADD brain. Yeah, so I see it as being all of the above, and it's really more a matter of opportunity, right? Like if you look at, well, I think, if you notice about 2 years ago, they talked a lot about buying new clinics, and now they're saying, no, we don't need to. We're just going to absorb clinics. And I think at the end of the day, the multiple you pay on some of these is, especially with our current multiple in context, it's easier to absorb new doctors. And so so a recruiting is probably my favorite thing. My second favorite thing would be a new build. And the third would be kind of buying something. But if we can find something interesting out there, we'll definitely look at that.
And then Joe, what do you think your capacity is right now for acquisition? If I look at your balance sheet, what should I be able to think you guys can do an M&A way?
Well, I think that's a good question because, we put that new $13.5 million facility in place. I think it was 3.5 credit, 6.5, and then the balance being acquisition line. We, we view that as really, National Bank is very good, is very supportive of really expanding this business. They didn't look at it as lending to us. They looked at lending to a much bigger us, right? And so they have, been repeatedly saying to us, like, look, if you want to do something bigger, just talk to us, right? And so I view that as being the biggest part of what we can do. I mean, at the end of the day, we'll just have to see what's out there and what we can do. But that buy versus build will still be out there. I mean, we're evaluating opportunities all the time. And I feel like with the balance sheet where it is now, we can definitely execute on what I would say is singles and doubles. So my hope is execute on singles and doubles, grow the EBITDA, grow that availability with National Bank. Maybe the stock responds, maybe it doesn't, then you just gotta, if it does, then we'll have more options there. So I think that's kind of how we look at it now. So I think we can definitely look at smaller operations. It's an interesting one. So you look at, like, I'll give you an example of Red Deer, right? Like Red Deer was a clinic that we built. It was a joint venture that we built with a group, an orthopedics group in Red Deer. And we funded it 50-50 jointly, put about $750,000, let's say, a ballpark it now, into that facility and startup costs, right? Because there was an operating cost. And now that business is our fastest growing clinic. It's went from 22 to being completed to now, let's call it, say, $3 to $4 million in revenue, and very profitable, right? So and you can probably, if everyone goes through our financials and they see the non-controlling interest, you can kind of do some numbers there, right? So it's kind of not hard to see that. So that was great, and so that was it's a great model that we did there, and a great, unfortunately, great partners that we worked with there. So, but that one didn't require a lot of capital. So, to go from, 2 years to get to, what, almost, let's call it, closing in on what, 8% of revenue, 7% of revenue, so I like that model a lot. I would love to do that more. But, so just sort of a sense of the kinds of things. But, if I'm looking at clinics, like, so if I look at a group of, a chain of 3 clinics in Ontario doing $12 million, maybe 20% EBITDA margins, right? That's the kind of four wall. And I know someone was asking about margins, and I'll talk about that a little bit in a second. But I think that at the end of the day, ideally, you're looking at, one, I buy something because I can consolidate it into an existing facility. So that's just a rationalization play. Two, I'm looking to buy something new in, say, Calgary, for example, and maybe it'll be lower margin than the rest of our business, but I know I can start layering on new people there. Then third, you're looking at entering a new market. Say, if I want to go into BC, there's a limited number of licenses. So if I had a license in BC, I can use that license to open new facilities within BC. But you need to have one of it's the cable model or the bandwidth model, right? For one of the big telecoms.
Okay, so you mentioned NCIB. I want to try to get in your head a little bit. And I like the way you phrased it. That you guys are kind of the cheapest acquisition out there.
Yeah.
How much do you want to allocate capital to that? Like, you've got opportunities on the M&A side, but I mean, do you want to continue to buy back stock if it continues to be down here, or do you, how do you
So
think that through?
we set it up as an automated purchase program at a relatively low level, and I want to say that clearly because this is a business that was financially distressed 2 years ago. I don't need to. If people go fishing through old press releases, they'll find things that were rather disturbing, right? And I'll direct them to April of 23. So this is a business that just got out of a dark day. So going all in on an NCIB 18 months after you had to do distressed financing doesn't feel like the right thing. So I think we did it measured to kind of make sure. The other thing too is we understand our liquidity. Yes, I know we're taking shares out of the market, but also just that natural bid being in there. So it's a small amount, and so when I look at my cash flows for the next year, I don't anticipate this being a big use of capital. It's a small amount. It would be a very small clinic acquisition for me. So.
Gotcha.
Over time, as this grows and after we get more confidence in the business, that could grow, right? So I think, if you've never done it before and you're in a distress mode and now you're rolling that out, you start out small and take baby steps. So that's how we view it.
Yeah, that makes sense. What sort of keeps you up at night right now? What's your biggest challenge right now running the business?
Keeps us up at night. Yeah, no, look, always, recruiting and retaining doctors. That's my biggest. How do I create a business that they are so happy with what we're doing that they never leave, and how do I show other doctors that why are you doing what you're doing? You should be over here. That's our biggest thing. On the cost structure side, we're slowly rationalizing. I know someone's asking about our footprint. We had when I took over, we had about 93,000 square feet. And by the end of 25, we'll be at about 68,000 square feet, right? So that's 25,000 ballpark square feet that we're taking out of the system at $30 a square foot, of which you don't see that all in our numbers because Mississauga was 17,000 square feet. We took our new Mississauga, which is 6,000, so 11,000 square feet came out of the system on August 1 last year. You've had 1/4 of that, right? There hasn't been a full year of that. London, we have 15,000 square feet. We're giving back half that to the landlord, and that'll be July 1 when that lease. That's in our financial statements. You'll see that lease is due in June 30th of this year. So we're giving back space. Surprisingly, that won't have any impact on revenue. So it's kind of we've been just that's a long story, but the history of the business, when we RTO'd, we were saddled with a lot of real estate, and now we have the opportunity. So there's no McKinsey level analysis here. We just were saddled with a lot of leases that are coming due in the last year, this year, and we're rejigging them. And I would say that probably by the end of this year, that footprint piece will probably flatline, and it'll probably track more with growth going forward. So I think that kind of addresses maybe a little bit one of the questions about profit margins. For sure, as we take all that out of the system, a portion of our rent obviously goes through our expenses. Portion goes to capitalized through the IFRS, but at the end of it, all of it goes through my cash flow, right? And so that's what the most important thing is at the end of the day.
Gotcha. Okay, why don't we dive on to some of these questions, because I know they're a little distracting, but we might as well address them now, and then we can sort of wrap up. Okay, so Jill says, on your balance sheet, the debt is posted as short-term debt. How are you planning on paying down the debt?
Yeah, so that was a good question because that was the press release with our year-end results. The second press release on the exact same time was our National Bank financing. So we've refinanced the whole balance sheet. We had that distressed debenture, high yield instrument that we retired. We retired our related party debt, which was due this year. So all of these things have been retired, and now we have it's a 10-year amortization on our National Bank term debt. So it's a great debt instrument. Honestly, I'm very pleased with where we came with that. So for you, Jill, we've just refinanced everything. So next quarter, you won't see short-term or short-term debt due this year. I did mention the lease space, I think, from Phil. In terms of the profit margins, so there's a couple things on the profit margin. Well, one for sure, adding in one of the things on the profit margin, a couple things. If I look under the hood and I look at my So let me talk about a couple, maybe try and be clear on this a little bit. So one thing I want to tell investors is that we have almost 10% of our business is non-clinics. So I have a research business in there. I have a staffing business in there that provides physicians to the prison system. And I have a assessments business in there. So I don't talk about that much because it's, it's under 10% of the business. But, so I really talk about my clinics business more. But those margins can also move around. So if one of them's growing faster, it can, play with the margin here and there. If I look at my clinics business, if I look at four-wall EBITDA on my clinics, you're anywhere from, 8 to 20% on my clinics, right? So I think that what I view is that over time, as I improve all those sub 10% to plus 10%, we continue to improve the business. And you're still stuck with that public company overhead. That's the challenge that we face. But if you look at the underlying clinics business, I think you see that continue to improve, both with the operational improvements we're making, as well as the lease rationalization we're making. So I think you'll see what we've guided, to the street. And we said, every time we make presentations, we think the underlying business at the 72, 73 million we're at, it should be 8 to 10, and we were a little over 5 last year. So we're not there yet. That's why I don't put the mission accomplished banner behind me. We're not there yet. But as we grow the business, so at 100 million, it wouldn't be 8 to 10, it would be more, right? And so the idea here is, how do I grow so that we can eat up more of that corporate overhead? The people that do billings, for our billings team, the people that, support, on the accounting, finance, purchasing, all this stuff, it scales well if I start expanding the business. So, the other thing is also at the micro level. So people talk about a macro level. How do I take the company, make it bigger so that corporate overhead is absorbed after a larger base? At the micro level, how do I make each clinic a little more operational efficient? I'll give you an example. Mississauga, Mississauga, we closed Oakville and our Toronto clinic. So in December of 23, we closed Toronto, and in October of that year, we closed our Oakville site. Actually, that was 22, sorry. So both of those closed, and my Mississauga revenues were up 50%, for example, right? It's because we relocated the physicians. My staff costs were up 0. So these are the kinds of things you can do at the micro level. So I talk about the macro piece, and that's why when I say, I'm comfortable saying, this should be an 8 to 10% business. Give me a year or two, I think we'll get there. But hopefully I can also grow the rest of the business, that we can absorb the rest of the overhead there. And that's a very detailed answer, I think, to that. But and then I addressed that, and the profit margins, cannabis. So we don't use cannabis in our clinics per se, and I haven't talked a lot about what we do, but a lot of what we do is injections. So knee injections, hip injections, trigger point injections, RF ablation, radio frequency ablation, where they stick needles into your spine. These are all kind of weird, complicated procedures. Patients may get cannabis, not in our clinics. And so the question is cannabis used for pain control relief? That's a good question, because to my knowledge, it is, right? And the question is how many, I don't know what level of people are using it recreationally versus, buying it or getting a prescription, like the medical cannabis. So cannabis is definitely being used. Is it being used? I suspect someone's looking at the prescription cannabis market there, or clinics there. I can't say for sure, but it's definitely being used. People use it. How they use it and where they get it, I can't comment.
And we get the one last question here from Maze. Why would clinic operators and owners turn to you guys and sell to you guys?
Sure. Yeah. So, I mean, the broader piece is, at the end of the day, most of the people that are running these clinics are doctors, right? So what are they doing on Saturday night? They're going through all their numbers and their billings and, calling their IT guy and all this. At the end of the day, it's a real effing headache. And what happens is doctors, it's funny when you talk to them about this, their first reaction is like, well, why would I pay you X when I can do it myself, right? And just as an aside, if I look at the network, we broadly, it's the 70-30 split with doctors, right? We take that 30 and I pay rent, hire nurses, buy medical supplies. And that's kind of what's left over is for shareholders, right? And so it can change a little bit based on procedures. There's different procedures with different numbers, but that's kind of where we're at. So for a doctor, that 30, well, now you walk in, you don't have to do all your clinical follow-ups. You don't have to hire and fire staff, toilets plugged up. You don't have to call the landlord. You don't have to call your accountant on the weekend to figure out your tax. There's a lot of, like, I know, there's a lot of work on that end. And I think at the end of the day, the reason why we've had so little turnover is because they come in and it works. The system works, and we try and make it better all the time. We make it better for them by, if I save the company money, they get a little bit back. We had a medical conference in October. We had 50 doctors fly into Niagara, and we had world leading experts from the US come in to talk about pain treatment, and we paid for all that. And the doctors came in, we comped them and so we gave them that kind of opportunity to interact with their peers from, because there's often this islands, ish, where they all, the Mississauga never talks to London, and, never talks to Ottawa, and you bring them all together and they could share best practices and that kind of, these are all little things that add up. People get together, they wear their corporate jacket, they go to the conference together, they walk in the morning and their schedule's full. They don't have to figure that out. Someone calls in sick, we figure it out. These are things that I always say, one of these things individually doesn't matter. It's how it all comes together. And so people sell to us, when we bought HealthPoint in Edmonton, that group are still working there. We had, I think there were 8 partners there, and 7 of them are still with us today, 3 years later. So, they've agreed that they don't want to do this anymore. And,
Yeah, it works. So you've been at it for a while. The stock is actually starting to perk up a little bit. Maybe just in general, like any change in the investor inquiry? Is there a little bit more interest now? What does that sort of dialogue with the capital markets look like?
Oh, yeah, it's kind of funny because I think it's gone from, I think there's still a microcap desert, I think, that you probably well know, for some time. And all of a sudden, cash positive and domestic is the flavor. So we're definitely getting different types of people now than we used to get, looking at the business. And, so there's a bit of that. And, I think when you look at the broader environment, like, look, I don't control any of that, but at the end of the day, I do think that the kind of business that we run is, how would I say it? It's a little more utility-like and less sexy. So when sexy is in, nobody wants to talk to us. I'm not sexy. But when things are, when the shit hits the fan, people are trying to find places that, good businesses that are positive cash flow. So I think that, and on that note, Christina was on the call, but our IR person was, we've been fielding some calls from Americans, that is that, I don't know if Q1, obviously some of the international markets have outperformed the US markets, and people looking for domestic only foreign stocks. We sort of fall into that. So I had some calls with the US investors as well. 2 years ago, US investor, Canadian healthcare, no interest. So it's changed a little bit. It's still the challenge of, I'd like to get some stock. Where can I get some? And that's a little challenge. So I actually view the broker warrants this month as an opportunity really to get some new people in.
Very good. Very good. Appreciate that. And like looking forward, what sort of new initiatives are you most excited about? You reeled off a number of different things that you plan on doing, but what gets you the most excited?
Well, most excited is expanding some new markets. Like there are markets in Ontario that we're not in. We're having some conversations there, expanding, Calgary, this buy versus build goes back and forth all the time. Very excited to get into some new markets. And I always say we want to serve more patients and more locations with more procedures, right? So I'm really excited about arthrosum. The initial response has been phenomenal. And so I think that's going to be, I'll be really interested to see where that goes, because being first mover advantage, being the first provider of this in North America, I think will give us a little bit of, when people Google the procedure, we're going to show up. So I think we'll always get that kind of first mover advantage there that'll help us over time. So I'm pretty excited about that, because at the end of the day, we want to be able to be in a position where it doesn't matter why you come in with a pain we can help you. You got that, we got, we got that for that. And
Mhm.
so I think that's what gets me excited more, is just having more quivers, more arrows in the quiver, so to speak.
Mhm. Yeah, makes sense. Okay, as investors on our side here, what do you think? What should we pay the most attention to? Maybe what metrics or catalysts? What do you think we should be watching for?
Well, I guess the first and foremost is continued improvement of margins. We know that all these real estate things that we're doing and have done, continue to flow through. And we built 3 new fluoroscopy suites last year, so those were expensive things that were empty, and now this year they'll be expensive things being used. So those will help as we go along, both in terms of revenues and in terms of margins. Beyond that, looking at the organic and inorganic growth, I would be very disappointed if I came out of 25 without being in new locations, either in the province of Alberta or Ontario, or in a new province. So organic growth, I want to layer on some inorganic to the organic that we've been delivering.
Mm-hmm. Fantastic. And then last chance, anything we missed, or is there any key takeaway you want to make sure everybody walks away with today?
Oh, we've gone over a lot. So no, look, just everyone, we're organic growth, domestic business, cash positive, helping a group of people that desperately need it. I think, one last thing I'll just mention on chronic pain is, if you know someone with chronic pain, these are not the people that, oh, my shoulder, I got a bum shoulder, I was playing, squash last week. These are people that, have gone through the doctor, gone through the NSAIDs, have gone through the opioids, have, gone through the cannabis, and now they're, doc, what else have you got for me? We're really, so I consider us as a very important part of the public system, and a very needed procedure. So I'm excited about being able to serve more Canadians and help them out when they really need us.
Fantastic. Fantastic. It's been great. We've been speaking with Joseph Walewicz, CEO of Neupath Health, symbol NPTH on the Venture Exchange. Joe, it's been great to catch up, and we certainly look forward to catching up in the near future.
Perfect. Thanks, Paul. Thanks, Trevor. Thanks, everyone else, for joining.
Appreciate it. Bye for now.